Hey guys, welcome back to my channel and welcome back to Austin, Texas. Kind of a cold, windy day here, or chilly. It's not cold, it's about 50. Hope everyone's having a great Saturday. So I was on my Discord, or not my Discord, I don't have a Discord. I was on Retire on Dividends Discord, and somebody posted a notice from the SEC or from ProShares that there was this new ETF coming out. And I don't think any of the people I follow have reviewed it yet. So I'm trying to be the first to look into it. If somebody else has done it, I apologize. I'm not trying to step on your toes, but hopefully I can be the first to this one. We'll see. All right, so the ProShares says ProShares is excited to announce the upcoming launch of iSPY, ProShares S&P 500 High Income ETF. Traditional covered call strategies typically rely on monthly options, generating income but potentially sacrificing returns. iSPY is the first ETF powered by daily call option, targeted by a daily call option strategy, targeting both high income and S&P 500 returns over the long term. They say it's expected to come out on December 20th, expected to drop on December 20th, I guess. So there's a webinar or seminar or something, and I'm going to try to get on it, the call, and I'll know a lot more afterwards. I'll make a follow-up video because I have this, really the prospectus gave me more questions than it did answers. But I'm going to try to get on the call. Now it says financial professionals only, but I am a financial professional, right? I'm a member of the press. I mean, I consider myself a financial journalist. I consider Retire on Dividends a financial journalist, especially after he got featured in Seeking Alpha. That's the first thing I saw this morning when I woke up, is somebody that wrote an article on Seeking Alpha is using Retire on Dividends for a source. Now, he's a great source. He's one of the best sources out there, but that's huge. That's this little YouTube thing and this alternative media is just going mainstream now. I remember it was a few years ago that Unusual Wells, or was it, no, yeah, it was Unusual Wells is what it was called. And he was just a guy that had a blog. I guess I didn't follow him, but it probably a YouTube channel, and he probably, you know, talked about a bunch of stuff. But anyway, then he freaking makes it mainstream, and it's an exciting time to not be in the mainstream financial press. The mainstream media and financial press especially is just so poor nowadays. It's terrible. I used to love Options Action, that show, and when I started researching the QQQY, they had an options action on, and one of the dudes from Options Action was saying that this strategy was like picking up pennies in front of a steamroller. Or he said nickels in front of a steamroller, but it's not. It's not at all. These options are 65 delta, so it'd be like picking up 65 pennies in front of a steamroller. Picking up a penny or a nickel in front of a steamroller means a 1 or 5 delta option. And those are way, way out of the money. Those are losing propositions. And those will make you blow up. If you sell those, you'll do all right for a long time, but then you will blow up. Okay, so I wanted to get into the backtesting first, and let's look at what I did find. Well, the bad news is I couldn't simulate any type of daily covered call strategy that had any type of alpha. This isn't the best backtesting engine. I'm pretty sure ProShares has better. They don't use the Tasty Trade backtesting engine. But needless to say, I couldn't find a covered call strategy that made money. I tried doing the synthetic and the monthly cycle and then selling the call in the daily cycle. I tried selling a 50 delta. I tried selling a 40 delta. I tried a 35 delta. Nothing worked. They were all losers. All right, so if you sell a put, these are the 65 delta puts. These are 1 day till expiration. They're the same puts that QQQY sells. Or for that matter, JEPY or IWMY. They all do the same strategy, the 65 delta put, 1 day out. Okay, but just looking on NDX, you win 72% of the time. Largest profit was $22,000 in March 2020. Think about that. This is supposedly a bearish strategy, or I mean, it is a bullish strategy. I'm sorry, selling a put is a bullish strategy. But how did it have the biggest profit ever in March of 2020? Does that make sense? You have to think about it, but it's because this strategy has two elements: how much premium you can collect, and then there's the element of the principal risk, whether or not your primary investment that you're tracking is going up or down. So, as far as premium collection goes, March was a huge, the biggest one in history for selling puts. Selling the call did not work out as well. Here's selling one out of the money call, and it has the same win rate, similar win rate, 71% as opposed to 72%, but the premium collected is about half as much, and the profit per trade is actually negative. This has a negative expectation. This is, that's unlike the put. Also, this had its largest loss ever in March of 2020, where the put strategy had its largest win ever in March of 2020. So they're just interesting things to consider. I want to get into the nitty-gritty of the prospectus now. All right. First thing I noticed is it must be nice to work up there in Bethesda, Maryland. That's a beautiful part of the world. These guys probably live in Chevy Chase, Maryland, or in, heck, maybe down in Georgetown, or maybe over in Virginia. Beautiful part of the world. It says investment objectives. ProShares S&P 500 Enhanced Cover Call ETF seeks investment results before fees and expenses that track the performance of the index. These guys seem to be a little bit more, put more emphasis on tracking the index than the IWMY guys do, just for whatever that's worth. Right here it shows a management fee and it doesn't have one. Other expenses, it doesn't have one. That it says 0 and 0. It's probably somewhere here in the fine print. Or what I'm also thinking is maybe it's built into the price of the strategy, or built into these swap agreements. See, this reminded me of JEPQ and JEPY. Instead of using the public market, it looks like they're using private market. There's nothing really wrong with that, but it just presents some other obstacles. For one thing, the first obstacle I can think of that I don't like about this is Retire on Dividends isn't going to be tracking this one, or like he can with the other ones. And I'm not going to be able to either. These instruments are not public. They aren't disclosed. This is a lot more private. So in that sense, reminds me of JEPQ. Principal risk. Here's a good one, and this is one I'm harping on all the time. This is your biggest risk when you do this kind of stuff. The principal risks described below are intended to provide information about the factors likely to have significant adverse impact on the fund's return and consequently the value of the investment in the fund. All right, covered call strategy risk, and I think people that invest in Tesla are pretty familiar with this one. I don't even know if I want to go into that one, but we know about the covered call strategy risk. They aren't going to recover as fast. You're going to get a lot of the downside. It's buffered, not all of the downside, but a lot of the downside, and then you're not going to recover as fast on the upside. So that's pretty much what that one says. I don't even have to read it. Counterparty risk. This is a risk you don't have with Jay and those guys. They use the public markets. The CBOE and the Chicago Board of Trade acts as a go-between, and they settle the transactions for you. So you don't have to worry about your counterparty running out of money whenever it's in the public market. These guys do. These guys, their counterparty may be Goldman Sachs, and these guys are JP Morgan, and they trade with each other. Now, do you have to worry about JP Morgan or Goldman Sachs going out of business? No, probably not. I mean, they're probably good for their counterparty risk, but was Bear Stearns good for the counterparty risk in 2006? And what about Lehman Brothers? Everyone thought they were good for their counterparty risk. Correlation risk. This reminds me of myself a little bit. Correlation risk is a nice way of saying tracking error. Tracking error is a nice way of saying drag, and drag's a nice way of saying erosion. Let's read this. A number of factors may affect the fund's ability to achieve a high degree of correlation with the index, and there is no guarantee that the fund will achieve a high degree of correlation. Failure to achieve a high degree of correlation may prevent the fund from achieving its investment objectives. Factors that may adversely affect the fund's correlation with the index include fees, expenses, transaction cost, income items, valuation methodology, accounting standards, and the disruption or illiquidity in the markets. The fund may not have investment exposure to all the securities in the index, or its weighting of investment exposure to securities may be different than that of the index. The fund may invest in securities not in the index. They leave it open for a bunch of bad things to happen, but this is where tracking error starts. is when the index is not as correlated with the parent asset as they like to be. Equity and market risk. This is basically just saying your stock can go down. Market price variance risk. This is just saying that the NAV of the fund will sometimes be trading at a premium or sometimes a discount to the actual true NAV of the fund. This is an important one to understand. Early close, late close, trading halts. This happens sometimes. It happened during 9/11. They just shut the market down altogether. This can happen. And if you're in one of these funds, and your fund may not be able to cover a position or something, and it's going to incur a loss that would have been unnecessary had the market just stayed open. But this is something they have to disclose and something you have to be aware of, because it's something that sure can happen. Principal investment strategy. So they don't give a lot of their strategy away, but here's something they did mention. They did mention they're going to use the passive approach to investing. So they're just going to buy the whole index is the way I take that. Same thing Defiance does. Now this is something that is good, I think, that JEPQ does. When I started looking into JEPQ and I started to warm up to it a little bit, what they do is they don't buy the whole index. They pick a certain concentration of stocks out of the index that they feel will outperform the index itself. So that's an extra source of alpha that this fund, or Defiance for that matter, won't have. The other thing though is it's not guaranteed alpha. If their picks could also underperform the market. But the good thing I do like about JEPQ, the way they do this, is they pick the individual stocks, but then they don't sell calls on the individual stocks. They sell calls on the index. So they're capping the performance of the index. But if the individual stocks they pick outperform the index, there's extra alpha in there for them. And I like that. I've warmed up to the JEPQ approach. This one is more like a Defiance approach, in that they're just going to try to let math do the trick, buy the whole index, sell the options, and just let math take care of it. So then they go on to cover a bunch of other types of risk they could have. They pretty much allow for everything. I didn't see anything about a zombie apocalypse in here, but pretty much everything else they thought of. Cybersecurity risk. Wonder if they get hacked. I guess it could happen. Here's something that I bet these ETFs did not used to have a disclosure, but that they're all going to have in the future. Risk of public health disruptions. If something happens like COVID again and they have to shut the markets down, there's nothing the fund can do about that. Then they also mentioned war, military conflicts, all kinds of stuff. Like I say, everything short of a zombie apocalypse. But this prospectus brought more questions than answers for me. I'd like to know more details on exactly what their strategy is. And I'd love to see a backtest. They probably won't publish one, but I just don't understand why they're using the calls instead of puts. On Tesla or NVIDIA, individual stocks, calls trade expensive, very expensive relative to puts. So that's why those covered call strategies are such winners for the single stocks, because you're taking advantage of the part of the option book that is more highly priced. You're going to sell calls if you're in single stocks, and you want to sell puts in indexes. At least that's what I've always been taught. I've always been taught you sell puts on indexes. I just don't get why they're doing it, but I'm sure there's a method to their madness. I'm excited there's more competition. So to sum all this up, I do like some things about the fund, but there are other things I'm not sure about. Like I said, more questions and answers. I'm going to try to get answers to the questions on Tuesday, and I'm going to also do more research between now and then. In other news, at the channel, the sad news with the squirrel is out as mascot. We had an HR issue with him. He was stealing other people's nuts, and we had to let him go. We don't tolerate that here. So I'm thinking about making Jax, my lab, the mascot going forward, or maybe one of the deer, maybe that big 10-point buck. I call him Tommy the 10-point buck. We'll see, but I also had to redesign the logos, which means I also had to redesign the merchandise. If you want to check out the merchandise, feel free to. You might make a nice gift for the dividend lover in your life. On the back side of that coffee cup, it says, "In dividends we trust." I thought about putting in "J we trust," but I thought that was a little too hokey, and I don't want to make Jay mad, and I don't want to seem blasphemous either. But I thought in dividends we trust would be a nice compromise. So if you guys are interested, I'll leave the link in the description. Thank you so much for tuning into this video. I really appreciate it. I hope you guys got something out of it. I probably missed a bunch of stuff, and there's probably other stuff that maybe was wrong. If you guys know of anything that I missed or that was wrong, please feel free to tell me so I can correct it in future videos. Thank you so much, and you guys have a great day.